Good morning. For the Capital Area Carcinoid Survivors Patient Support Group, we are pleased to have with us this morning Jeffrey Kolender, who is chair of the Paley Rothman Estate Planning and Estate and Trust Administration Department. Mr. Kolender is an attorney and has offered to come and talk to us this morning about some of the basics of estate planning. In the email notice that went out, there was a link to Mr. Kolender's profile and numerous accolades. So we're very fortunate to have him be willing to speak with us. Jeff, good morning. I turn it over to you.
Good morning, everybody. I'd first like to thank Barry and the group for letting me listen to a few minutes of your stories and inviting me to be a part of the presentation. I appreciate it. So many people find estate planning intimidating, but it really shouldn't be. As we'll see over the next half an hour or so, there are a lot of factors to consider in structuring a good estate plan, but if you break the estate plan down into its parts, it's not as difficult as it may appear on first blush. What many people do not know is that if you do not have an estate plan in place, the state will write one for you. Not a written plan, actually, but all states have laws in place that say if you do not have an estate plan, the state will determine who will receive your assets. And many married couples are surprised to learn that the surviving spouse does not receive the entire estate. The state will determine who will serve as your executor, how your minor beneficiaries will receive their inheritances, who will serve as guardians for your minor children, and who will make medical and legal decisions for you if you become incapacitated. So broken down to its simplest form, estate planning gives you control over what happens upon your death or disability. You control how your assets will be distributed and who will make decisions for you. There are difficult decisions involved and no perfect answers. However, it's better to have something in place rather than nothing, knowing you could always revise it in the future. And while estate planning is not fun for most people, it is best to do it when you have the time to carefully consider how to structure the plan. Waiting until later, or maybe when you're ill, can result in not having the time or ability to create the plan, or a rushed and not well thought out plan, stressful to everyone. So I'm going to set up the slides now. So the first question that, we'll talk about 10 things. The first question is there any planning I should do to protect myself if I become disabled? And this is really important. Estate planning is not just providing what happens upon death, since there is a strong possibility that many of us will become incapacitated for at least some period of time. You'll want to plan for it. Without it, problems can arise. So we generally recommend that you have 3 documents in place to plan for incapacity. First one is a power of attorney, where you're naming somebody to pay your bills, to sell your assets, to file income tax returns, to file insurance claims, deal with retirement accounts, all those things if you become incapacitated. If you don't have the power of attorney in place and you become incapacitated, somebody's going to have to go to court to get a guardianship created for you to do all these things. The guardianship is expensive, it's cumbersome, and it's restrictive. So it's not a good idea. Power of attorney is a fairly simple document to get in place. Second document in place that hopefully everybody has is an advance directive, which basically has 3 parts to it. A healthcare power of attorney, where you're naming somebody to make medical decisions for you if you can't make them yourself. A living will, where you're setting forth your wishes about the medical procedures to take if you're in a severe situation, and also post-death things. You want to be cremated, you want to donate organs, all those type things. So you're setting forth your wishes for your healthcare agent to follow. And the third incapacity planning document that we recommend is what we refer to as a Hipaa Authorization, where you're probably familiar with the Hipaa rules that a doctor can only speak to you about your medical situation. We want them to be able to, the doctors to be able to talk to the people named in the power of attorney and medical directive. So the power of attorney, medical directive, and Hipaa authorization are all important documents to have in place. On a side note, if you have minor children, as you know, the parent has the legal right to make medical and financial decisions for the child. Once a child is an adult, however, which is 18 in most states, the parent no longer has that right to make these decisions on behalf of the kids. Further, if the adult child is ill, your child's doctor probably won't even speak to you to tell you what's going on. So to avoid these issues, we strongly recommend that adult children have the power of attorney and the medical directive and the Hipaa authorization in place as well. Next slide is, are beneficiary designations important? And the answer to that is a resounding yes. Probably the most overlooked part of estate planning. For many people, life insurance and retirement accounts are a significant portion of their estates, and we want to be sure that those assets are distributed in a way that's consistent with what you have in your will. We often see clients who come in with these very expensive estate planning documents in place, but have beneficiary designations that do not coordinate with that, and their estate plan is a mishmash. So it's important to have the correct beneficiary designations in place. For example, we see sometimes a designation will say, my spouse is the primary beneficiary and my newborn child is the contingent beneficiary. What's wrong with that is, A, what happens if you have more children? That child is, the newborn children are disinherited, and it would go to a minor child if the child's a minor at the time of your death. So there are ways to structure it to say more, whatever I have in the retirement accounts go to the trust created under my wills for my children. So that way you cover the situation if you have more kids, and it ensures that a minor child doesn't get access to money. Slide number 3. And I think I'm going sort of fast because we have a lot of things to talk about, but I think there's time set out for questions afterwards. So I'm more than happy to talk afterwards with the questions you have. Slide 3, are trusts something I should consider? And the answer to that is maybe. There are all kinds of trusts out there. Many people think trusts are just sort of an exotic entity and playthings of the rich, and they can be, but they're also helpful in many more common situations. And we'll look at trusts over the next few slides, but the 3 most common reasons people create trusts are A, to avoid probate, B, to save estate taxes, and C, for asset protection. So again, we'll look at those in a few minutes, but there are a lot of situations where trusts can be very helpful. Next slide, number 4. Can I protect my child's inheritance from a bad spouse? Everyone's heard a story about a child receiving an inheritance and then losing a significant part of the inheritance upon a subsequent divorce. And can we do anything to prevent that? Yes. As background, though, as a general rule, inherited property is not considered marital property, especially if the child keeps the inherited assets in a separate account rather than a joint account with the spouse. However, what you often see children receiving an inheritance do is to place those inherited funds in a joint account with the spouse, or use some or all of the funds to buy a house that's titled jointly with the spouse. Or the child could keep the account separate, but will place earnings from his or her job into the same account with the inherited assets. And now you're commingling separate property and marital property. So while the general rule is inherited property is not marital property, it doesn't always end up that way. So one option to protect the inheritance is to place the child's inheritance into a lifetime trust for the child's benefit, rather than giving it to the child outright or putting it in a trust for the child that ends at age 30 or something like that. With these type trusts, you could name a trustee to manage the money and make distributions to the child. And then maybe when the child's 30 or 35 or whatever age you think the child can handle the issues, make the child the trustee. So the child can take money out as a trustee for his or her benefit and for his or her kids' benefit. But because the funds are set aside in a separate account, they're clearly segregated from marital assets and do not become marital property. Now, these lifetime trusts have other benefits as well. They're often protected from the child's creditors, which is especially helpful if you have a child who's in a high-risk profession, such as a doctor or a lawyer, or if the child has trouble managing money. And a third benefit is that the assets in the lifetime trust avoid estate tax in the child's estate. For that reason, you often hear these trusts referred to as generation skipping trusts, not because they skip the child's generation, but because the estate tax skips the child's generation. So this is a very common thing we do to have the best of both worlds, where your child could have access to the money, but it's protected from creditors and bad spouses. Next slide. Do I need estate planning if my spouse and I own all of our assets jointly? Many people think no, but the answer really is yes. There are at least 4 reasons I can give for that. One is maybe there's no problems on the first spouse's death since everything is owned jointly. But what happens if both spouses die together, or if the surviving spouse is not competent to make a will at the time of the first spouse's death? What's going to happen then? 2, oftentimes people don't realize that there are some assets which are not joint. Maybe the inherited assets, maybe stock options in the employer. And as we briefly mentioned earlier, if you die without a will, assets in your own name, not all of them go to your spouse. The third reason, as we talked about a little while ago as well, is estate planning is more than just planning for death. You want to have powers of attorney and medical directives in place. And the fourth thing is that, estate planning is more than just planning how your assets are distributed. You need to name guardians and executors and trustees and all that. So estate planning is very important, even if you have your assets titled jointly. Slide 6, for some reason, doesn't seem like the title was there, but this is, what is probate? Do I need to worry about it? Yes, maybe. This is a different answer for lots of different people. So let's really look at what probate is. When someone passes away, there are a lot of things for an executor to do. File final income tax returns, pay off creditors, retitle assets, and probate. Simply put, probate is the court supervision of the estate administration process. The probate court wants to know what the assets are and who the creditors are. Have you paid off the creditors? Have you paid taxes? There's a lot of things they want to see. And different states have different rules for what probate procedures are required. Maryland, for example, is not a difficult probate state, but it does want the executor to file an inventory within 3 months of death, where you're showing all the assets passing under the will. And it wants you to prepare 6 months later an accounting where you are showing all the money that came into the estate, which could be health insurance refunds, cable refunds, interest and dividends on your investments accounts, and also all the money that came out of the estate, paying off bills, paying your accountant, your attorney, all that stuff. So it's a time-consuming thing. And most people who have jobs and families and all that don't want to spend their time doing those accountings. So they hire people like me to do it. So it costs money for the estate. All that being said, people hear all kinds of horror stories about probate. It takes years, costs tons of money. And there are some situations, unfortunately, when that happens. But in general, most estates don't have crazy probate issues. But there are ways to avoid the probate process to make your executor's job easier. And to understand that, you need to know that probate applies only to assets passing under your will. So, for example, life insurance and retirement accounts, if you have beneficiary designations in place that say all those proceeds go to my kids or my spouse, those are not probate assets. The probate court doesn't care about it. You don't need to worry about that. But for your other assets, things are titled in your name, whether inheritances or real estate, things like that, what many people do is to create what's called a revocable trust. Trust that you create, you are the trustee, you put assets into the trust, and you have complete control over all of it. So you're not giving up any access to the trust assets. But because the trust document says that you do whatever you want to, and then upon your death, it goes to the people named in the trust, the assets don't pass under your will and avoid probate. So it's a fairly easy way to bypass the probate process to make your executor's job easier. There's some things you got to do now to create the trust, to fund it and all that, but it's usually easier to do it now rather than later. And there are some situations where having the revocable trust really is almost a no-brainer. And the primary one with that is if you own a beach house in Delaware, for example, not only will you have real estate, you have probate in the state in which you're living, you'll also have what's called ancillary probate in Delaware as well to deal with the beach house there. So you'll have two probates to deal with. So those situations, it usually makes a ton of sense to do the revocable trust. In some other situations where things are a little simpler, maybe not, again, like with much of estate planning, it's a case-by-case basis. You can also get around probate in some situations by doing what's called a payable on death, POD, or transfer on death, TOD, well, with bank accounts and investment accounts where that can go directly to a named beneficiary, almost like a beneficiary designation for your life insurance or retirement accounts. But that has some issues that I don't want to get into now, but it can be appropriate in some situations. Slide 7. I am in a second marriage. How can I protect my spouse and at the same time ensure that my children from my prior marriage are not disinherited? Now, with the traditional nuclear family, married couple usually has traditional identical goals, providing for both the surviving spouse and the couple's children. And the children are the children of both spouses, so they have identical goals. However, with blended families, which are becoming more and more the norm, things can get a bit more complicated. Sometimes it's easy where both spouses are financially comfortable. Spouse number one leaves all of his or her assets to his or her kids. Spouse number two leaves all of his or her assets to his or her kids. No problems. The other situation, though, is where the spouses sometimes will have dual and potentially competing interests, where they want to provide for the surviving spouse, but at the same time ensure that the first spouse's kids will get an inheritance upon the surviving spouse's death. And oftentimes the couple come in and say, I trust my spouse, he or she will do the right thing and get my share of the assets to my kids if I die first. Unfortunately, as you may have seen, things often change upon the first spouse's death, with the surviving spouse no longer having a positive relationship with the first spouse's children. And we've seen that situation arise where the surviving spouse, which he or she has the right to do, change his or her will to disinherit the first spouse's kids. And that is not the result they wanted when they first came in for their estate planning. So a potential answer for this is for the spouses to each create a trust, or for the spouse's wills to say that on the first spouse's death, his or her assets go into a trust for the surviving spouse's benefit. Surviving spouse can receive benefits from it, but the assets are protected so that on the survivor's death, those assets will go to the first spouse's children and the surviving spouse's assets will go to his or her children. So it's a way to ensure that all your goals are met, providing for the surviving spouse and providing that each spouse's kids get what they should. Two quick notes on that. It's often recommended that on the first spouse's death, he or she leaves something to his or her kids. This could reduce animosity toward the surviving spouse and not have the first spouse's children just anxiously awaiting for the surviving spouse to pass away. Second, and as you may know, when couples marry, each spouse accrues certain rights upon death or divorce. So it's usually and strongly recommended upon a second marriage for the couple to consider a prenuptial agreement before the marriage to help define what happens at death or divorce. Slide 8. Do I need to worry about estate or other taxes? So let's first look at what the estate tax system is around here. Under the federal laws, everyone can pass $12.06 million of assets free of the estate tax. That amount goes up each year for inflation. However, it's supposed to be cut in half to 6 million plus by January 1, 2026, unless Congress changes the law before that. And there was a strong push the end of last year to change the law. And a lot of the wealthier clients created irrevocable trust to take advantage of the exemption then in effect. However, it did not get passed. So right now we still have that 12.06 million. What some people don't realize is that there's a lot of things subject to the estate tax. It's not just your investments, it's your retirement accounts, it's your life insurance policies, it's your personal property. Basically, they'll look at everything to determine what the value of your estate is. So many people really don't realize what the true value of their estate is. So that's the federal estate tax. There's also, each state has its own estate tax system, or at least most states do. Maryland says that there's a 16% estate tax on any amounts over $5 million. DC says there's a tax on any amounts over 4.24 million, and that goes up for inflation each year. And Virginia, for those, I guess, lucky residents, there's no estate tax for people there, no state estate tax. So that's sort of the background. The other thing you should know is that there's no estate tax for amounts passing to a surviving spouse. So with one exception that we'll talk about in a minute. So generally, there's no estate tax until the surviving spouse's death. So the first rule of estate tax planning is to ensure that both spouses get this exemption. You know, for example, with the Maryland estate tax, that a married couple can pass $10 million free of the estate tax, not $5 million. And a full discussion of this is beyond the scope of our talk today, but let's take an example. If a married couple living in Maryland has $8 million of assets, and again, that includes life insurance and retirement accounts, then, and does no estate planning, no tax on the first death. On the second death, there'll be a $480,000 tax on that $3 million over the $5 million. With estate planning, though, you can have it so that both spouses take advantage of their $5 million exemption so that there'd be no tax on the second surviving spouse's death. So a little tax planning can go a long way. Another tax that we Maryland people should know about is what's called the inheritance tax. It's one of the only states in the country, I think there are 2 states, that have an inheritance tax, which is in addition to the estate tax. It's a 10% tax on any amounts passing to a non-exempt individual. Exempt individuals, such as spouses, ancestors, descendants, siblings, and charities, are not subject to the tax. But amounts you leave to a friend, to a niece, a nephew, they are not exempt and will be hit with that 10% tax. So unfortunately, the tax is what it is. Not much you can do about it like you could do with estate taxes, but 2 things to keep in mind. First of all, if you want to leave money to a non-exempt individual, such as a niece or nephew, maybe consider leaving it to your sibling, who can then gift the money to the beneficiary, to the niece or nephew. That way, since the sibling is not subject to the inheritance tax, you can avoid that 10% tax. Second, if you're going to leave money to a non-exempt beneficiary, you want to include a provision in your will saying whether the beneficiary pays that inheritance tax or the estate pays it. So for example, if you leave $100,000 to your nephew, do you want him to get $90,000, which is the 100,000 reduced by the 10%, or do you want the estate to pay that tax and the nephew get the full 100,000? There's no right or wrong there, but you just want to give the executor guidance so he or she knows what to do. And finally, with this slide, gifting. Everyone can give, the number now is $16,000 a year to anyone you want to in any calendar year without having any gift tax consequences, without having to tell the IRS about it. The number was 15,000 until January 1st. It goes up every 3 or 4 years for inflation. So that's a fairly easy way, if you can afford it, to make gifts if you're on the borderline to pay estate taxes. And there's other more sophisticated options out there if you're in a situation where you want to reduce your estate tax further. That again is a topic for another day, but it's out there if you want to think about it. Slide 9. The heading is wrong on this. It should say, are there estate planning considerations for non-US citizens? The answer is maybe, with primarily dealing with tax issues. As I briefly mentioned earlier, generally amounts passing to a surviving spouse are not subject to estate tax. The tax only kicks in on the survivor's death. But with if the surviving spouse is not a US citizen, the amounts passing to the non-citizen spouse may be subject to estate tax at that time, unless you do some planning to create what's called a qualified domestic trust or a QDOT to shelter the tax. Again, it would be only kicking in at the survivor's death there. The other thing to keep in mind, whether you're a US citizen or not, is issues can arise if you own property in another country. You know, none of us here know estate tax laws or state laws in all these countries around the world. It's generally recommended if you have property in another country that you do a will in that country just for the assets there. US will covers all of your assets except that real estate. The will in that country covers the real estate. And slide number 10, what else do I need to think about? And I'll touch upon another topic, a bunch of topics here, hopefully won't take long. First, burial, cremation, whatever you want to do, let your family members know what your thoughts are. If you've purchased a plot, if you want to be cremated, nothing more stressful than somebody passing away and trying to figure out if there's a plot purchased, what the thoughts were, anything like that. So easy enough thing to do. Let your kids and or other family members know about it. Joint assets with children. That question comes up a lot where people will say, especially widows or widowers, should I make it easy to title assets jointly with my children? Is this a good thing to do? And it has both good and bad parts to it. The good is that it avoids probate later upon your death because it's owned jointly, passes directly to the kids. It also helps allow your kids pay your bills during your lifetime. As you age and don't want to deal with it, the kids are joint on the checking account and can pay the bills. Third, it provides liquidity to help pay the bills that come up upon your death, funeral expenses, etc., that otherwise your kids probably would have to pay out of their own pockets until the estate is open and the executor has access to the money. The bad part about owning accounts jointly with kids is that A, the child can take money out for his or her benefit, which is probably not what you intended. B, if you own an account with, let's say, 2 kids, what happens if, God forbid, one of your kids predeceases you, all that money goes on your death, all the money in that account goes on your death to the surviving child. The deceased child's children are cut out from receiving that part of the estate. So it could be problematic. Third, an account you put in jointly with the kids, even though it's, quote, your money, it potentially could be subject to that child's creditors. So there are good and bad about owning accounts jointly with kids. I think the correct answer is maybe for small amounts as you're aging, maybe it makes sense to give them access to the money to pay bills, but for bigger accounts, I don't think it's a good idea generally. Sort of related to that is, should you get your children involved with your own estate planning? And that's another case-by-case basis. A lot of times, again, as you're aging, it's a good idea that the kids know how to find your will, how to get access to your money if you're incapacitated. So I think it's a good idea at some point to let the kids know things, maybe not know the value of your estate, but know how to find where your assets are, how who your financial advisors and accountant and all that is, just to ease the transition upon incapacity or death. Next, digital assets. And this is sort of the wild west of estate planning, with more and more people having Facebook accounts, with handling their investments online. It's often difficult to deal with institutions upon death or incapacity because they're afraid of being sued and don't want to give any information about the passwords or anything to the power of attorney or executor. So it's important to put provisions in your wills to deal with that, to give executors the right to access your digital assets. And maybe, as importantly, have a place where you have your passwords written down, where you have, make it easy for your kids to find things if they need to access your assets. And that actually brings up another point, is that organization is so important. If you have something listing where your assets are, who your advisors are, how to access things, it makes your executor's job so much easier, rather than them having to scramble around trying to find where your assets are, who your lawyer is, how to deal with things. Next, when to revisit your estate plan. This, the rule of thumb among estate planners is every 3 to 5 years. Family circumstances change, tax laws change, who you want to name as guardian, executor, all that changes. So it's a good idea every 3 to 5 years, not necessarily having to visit your lawyer, but at least going through the documents to be sure that the people named are still the ones you want. Next, keep your advisors involved. You know, most people have an estate attorney, they have a CPA, they have a financial advisor, they have an insurance professional. The more people who are involved with the estate plan, the better. Each can contribute something to the estate plan to ensure that you get the best possible plan out there. Sometimes, you know, clients come in and forget to tell me something that the life insurance agent or accountant knows about, so leaving that out would have been a problem, but having the advice of different people in the room makes the job more complete. You know, you can never have too many smart people in the room, as far as I'm concerned. And if you have an estate attorney who doesn't want the advice of the other people involved, I'd be a little leery. Charitable bequest to family and charity. We basically have been talking about leaving assets to spouses and children. Some people want to maybe provide for their parents or their siblings. Some people have charitable goals. Well, I won't go into detail about leaving money to family members. That is something you should bring up with your estate planner if that is an issue for you. For charitable bequests, there are a few things for you to consider as well, in addition to how much you're going to leave the charity. First of all, charitable bequests are most tax efficient if they come from IRAs or 401ks or other retirement accounts. Anything, you know, for example, if you leave $100,000 from your IRA to your son, he's not getting 100,000, he's getting 100,000 minus the income taxes, unless it's a Roth IRA. If you leave it to the charity is a non-taxable entity, gets the whole $100,000. So that's issue one. Issue two, if you leave money to a charity, you should state, do you want it to go to the general funds, or do you want it to be used for a specific purpose? Should it go for scholarships or for research or whatever? You have the ability to dictate that. Third, you should check into the entity's tax status. You know, bequests to a qualified charity, commonly known as 501c3s, are tax deductible. Contributions to non-qualified charities are not. And finally, what happens if a charity is no longer in existence? You should put something in the will about it. Maybe the bequest lapses, so it doesn't get paid to anyone. Or you could say it goes to a similar charity that has similar goals. Again, just things to think about with charitable bequests. Non-traditional relationships, for unmarried couples, special estate planning should be implemented. For a married couple, we talked about how there are all these rules under the tax and other laws. There's no estate tax passing to a surviving spouse who's a U.S. citizen. The surviving spouse has parental rights for the couple's children. State law generally provides for the surviving spouse to receive some, but not all, of the first spouse's assets. So these rules, unless you could prove common law marriage in those states which have it, Maryland is not one of them, do not apply with unmarried couples. So beneficiary designations, asset titling, will provisions, which are important in any estate plan, become more important for unmarried couples. And finally, family members receiving government benefits. If you have a child or other family member who's receiving what they call need-based government benefits, such as SSI or similar things, giving money to that child, either outright or in what I call a normal trust, could result in the child no longer receiving the benefits, because the trust assets are considered available to the child and disqualify him from the benefits. If, however, you place the assets in what's referred to as a supplemental needs trust, the assets are not considered a resource and will not disqualify the child from receiving the government benefits. So that is my 2 cents worth. I'm happy to answer any questions people may have.
Jeff, thank you. That was a little bit like drinking from a firehouse. A lot of information. Questions?
Can I suggest that any questions be put in a chat so that you, Barry, can then pose the questions to Mr. Kolender? Would that be easier?
Sure.
I'm game either way personally, but whichever you prefer.
Well, I'll start out with one. I had a question which I think you answered, but it was essentially, how much information do you share with a child who might become a trustee in your estate, and a beneficiary?
Again, it's sort of a case-by-case basis. Generally, with wealthier clients, most clients are a little bit hesitant to let the child know how much is there, because you don't want to disincentivize the child from working and realizing his or her full potential, knowing that some big inheritance is coming down the road.
Right.
So that is sort of one factor to consider. What you usually see is at some point, like I said, usually somewhere when the child's between 25 and 35, you let them know some of the estate plan, just sort of broad strokes. And then down the road, when the child's established and you're not as worried, hopefully, about his or her disincentivization, start leaking more information out.
Thank you.
Let me ask the question this way. I have a friend of mine who made a comment that you never really know someone until you share an inheritance with them. With all the planning, what happens when there are challenges?
Yeah, that's potentially an issue down the road, in that, you want to try to potentially put provisions in there to stop somebody from challenging a will. For example, sometimes you can include what's called a forfeiture clause that says that anybody who contests the will loses his or her inheritance. That is a little problematic, because if somebody has a legitimate gripe, if an individual was coerced into doing a will, or if the executor is stealing money, you don't want to stop a beneficiary from being able to sue. But if it's more a illegitimate type case, that type of provision can disincentivize somebody from suing. That being said, there are some situations where if you could find a lawyer to take a contingency fee, what's to stop a beneficiary or potential beneficiary from suing just to be a nuisance? Sometimes they will, someone will sue just to try to get a settlement out of there, knowing, what do I have to lose? I didn't receive anything, so I may as well try to receive something. So the long and short of it is there are provisions that you could put in there to discourage people from suing, and you want to make the provisions of the will and or trust as tight as you can, but it's almost impossible to stop somebody who wants to be a pain, to totally stop them from being a pain. Wish there was a better answer than that, but.
We've got a question that came in. It said, I recently set up a children's trust, but have yet to change the beneficiary designation on my accounts because it's not an individual's name. How do I name the trust? Does it have its own name?
Assuming we're talking about children's trusts which are created currently rather than are being created under your will, there should be a name with the trust that's on the first page of the trust document that was created. The trust may, depending on how it's structured, may have its own taxpayer ID number as well. So there should be some easy way to designate the beneficiary to it. But again, the lawyer who helped prepare it should be able to give you the name pretty easily. If I understood the question correctly.
Someone has asked, are there any restrictions on the minimum size of a trust?
There are no minimums for it. It's, again, I assume that question is dealing with a revocable trust to avoid probate, where there are really no minimums with that. Avoiding probate is a helpful thing to, regardless of the size of the estate. I mean, if we're talking about a $100,000 estate, maybe it's not worth it. But avoiding probate is helpful for just about any size estate. If it's an irrevocable trust where you're making gifts, that's where there may be some minimums, because most of these trusts have gift tax, income tax returns and other things. So you probably need a couple $100,000 in there for a gifting trust to make it worthwhile. But for a revocable trust, I usually don't feel there's any minimum amount.
It might be worth it to mention what's the difference between a revocable and irrevocable trust. And along with that, there's a question, what's the distinction between a qualified and non-qualified beneficiary?
So the revocable trust is what we talked about earlier, where it's really done just to avoid probate. It's basically your will, just in a trust form. And by revocable, it means you can change or revoke it at any time. Just like you can change your will at any time, you can change your revocable trust at any time. An irrevocable trust is usually done either to save state taxes or for asset protection. That's a much more intense trust, where once you create it, you cannot change it. So you really need to go in there with knowing that whatever you're putting in that trust is gone. So that again requires more thought to be sure that the irrevocable trust is the right thing for you. Usually making gifts to somebody is in an irrevocable trust. Since you have to give up access to it, it's irrevocable. You can't reach those assets. Revocable trust, it's not a gift. It's just something you're doing is really in along with your will. Now for the qualified versus the non-qualified, I assume we're talking about charities there.
It says a qualified and a non-qualified beneficiary.
So if the question is referring to charities, any charity that filed the appropriate documents with the IRS and gets itself deemed by the IRS to be a 501c3 is a qualified charity. if the organization has not done that paperwork, or certain organizations by definition cannot be qualified charities, things like political organization groups, things like that. So you can look on a website or contact the organization to see if they are qualified or not.
We have a question on the gifting. Is the $16,000 amount the total per year from the estate or per recipient?
16 per person per recipient. So I can give $16,000 to each of my 6 kids and to each of their 6 spouses. Not that I have 6 kids, but if I did, it would be to each of the 6 kids and to each of their spouses and to each of my grandchildren, and my spouse can do the same thing. So basically, a married couple can give $32,000 a year to each child, each grandchild, whoever they want to give it to. And by the way, it's per calendar year, not per 12-month period. So you can make a $16,000 gift on December 31st, and then another one on January 1st.
Question, recently had an estate appraisal on their house when their husband died. Are there more tax reduction steps to take?
Probably the answer is no, but there's a lot of possibilities out there that I can't give a complete answer to. And just for informational purposes, if you bought the house, let's say for $100,000, and now it's worth $300,000, upon your death, the beneficiary gets what's called a stepped-up basis. If you sold it during your lifetime for $300,000, you'd pay a capital gains tax on that $200,000 of gain. But when somebody owns a property at death, the beneficiary gets that $300,000 basis in that example. So it's much less of an income tax bite if you sell the assets. So that's an important thing, that when any assets you inherit, you know what the cost was at the date of death, not at the date the person purchased the asset.
Are there assets that you would not recommend placing in a trust, and what are some examples of the disadvantages of a trust?
Examples of the, again, I assume we're talking about a revocable trust. The primary asset that can be a hassle sometimes is your house. Some mortgage companies don't want to refinance houses that are owned by a trust. We've actually had situations where a mortgage company told us, when the house was in a trust, deed it out of the trust, refinance, and the next day deed it back into the trust. So that can become a little bit of a hassle if you have a real estate that you may want to refinance in the future. Second, as a general rule, retirement accounts and life insurance are not owned by the trust. You own those yourself. So those generally don't get transferred into a trust. You want to be sure the beneficiary designations for the retirement accounts and life insurance are done correctly, but you don't actually put them into the trust during your lifetime.
Any other questions? Okay.
Okay, if anybody has any questions they want to email me or call, please feel free. Not today, but during the work week, more than happy to speak to people for any questions they may have.
That's great. Jeffrey, thank you very much. I really appreciate your taking the time to come and give us an overview of this.
My pleasure. Good luck to everybody there.